And in this case, because they need basically the full purchase price, not just the down payment. If you're looking at a $650,000 bridge loan for 10 days, I mean, that might end up costing them literally like $25,000, you know?
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren.
Hello and welcome back to the Ottawa Real Estate Podcast 2026, your go-to source for all things Canadian real estate. My name is Paul Stevenson. I'm joined by David Warren. We're both level 2 mortgage agents. And Happy New Year, David. We want to give a quick shout out to our amazing sponsors, Gerté Poirier Avocat Lawyers, Big Insurance in Westboro, Centum, and Easy Neon Signs. If you go to easyneonsigns.ca, use the promo code TOREP, you can get 20% off each and every order. David, we're back. It's 2026. It's a new year. How you doing? What's going on? It's been a month almost. It's kind of crazy.
It's it was it's always weird starting the new year every year. You're kind of in that 2025, 2026, mixing things up. Wild to think that we are the start of a new quarter century. To make us feel, just trying to make us feel old. But no, the break was nice. Can't really complain. Christmas was good, other than being cold as all can be and a ton of snow here in Ottawa. But
yeah, January for real estate is always an interesting time because really there's no, it doesn't actually change anything. Like the calendar flipping over doesn't change anything in the market. As far as number of homes listed, people shopping, but mentally and just psychologically I think for both people in the industry and for buyers and sellers, it feels like this fresh start every year. Okay, we're starting from scratch again, which we're not, but it feels that way. It feels like as soon as that clock ticks over January 1st, you're like, oh my gosh, it's a new year.
New me.
Yeah, we got to go. I got to get to the gym, I got to get that diet started. But no, I think there's kind of a renewed sense of optimism. I think people are just, a new year, fresh start, fresh outlook. So it always does feel refreshing, but it's just funny that every January it feels like, for whatever reason, everyone is starting from scratch again, which isn't the case, but it does feel that way sometimes,
Yeah, and I as I mentioned before the Christmas break, that I typically get a purchase agreement between Christmas and New Year's, and the universe didn't let me down this year again.
Okay.
Yeah, December 27th purchase agreement.
There's always one
clockwork every year.
Yeah. And I mean the holidays, I felt, just to sum up the last 3 weeks, I felt like it was the first year where I actually checked out. So I had a few conversations, but very brief over the holidays, like people that were, our realtor message saying, hey, we're at this open house. Can you run this number quickly? Something just like that. But otherwise, very calm, very relaxed, couple questions here and there. But I kind of advised my clients before leaving, listen, I'm going to be offline for 2 weeks. Basically, banks are pretty much closed for most of that, but I'm here if you need me, sort of thing. And it was great.
Mm-hmm.
Most people were very understanding and no one had any questions and there was no fires. So it was actually a very nice kind of reset going into January. And this year I've found a lot of conversations. People are shopping, a few APSs last week. So people kind of hitting the ground running, but a lot of conversations about renewals coming up, like February, March, April, a lot of those conversations happening. And a lot of realtors that are seemingly out with buyers that have questions about, we're going to see this, we're doing that, can you run that? So definitely there's movement in the market. I wouldn't say it's, we're not talking spring market here or anything yet, but I would say we're going to see things kind of ramp up. And we have the numbers from December, which were a bit slower as we expected. But I think, overall, at least the seems like everything has kind of balanced out now. I think the sentiment I'm getting from realtors is that they feel like it's a true balanced market. Whether they're on the sales side or the buy side, it seems as though they feel it's fair, it's equitable on both sides. Nobody's really at an advantage. I still think buyers have a bit of an advantage, but generally speaking, I think the realtors that are working with buyers and sellers feel like it's a balanced market, which is exactly where we want to be. And to me, that actually makes me optimistic about 2026.
Yeah, I think in any space when it's a balanced market, it's a win on both sides. We've talked about in years past when it was a seller's market. It's not equitable. It's not fair on buyers. They're having to make rash decisions, and then getting that buyer's remorse. Really, in a balanced market, you're getting that true negotiation. You're getting those conditions included for the protection of both buyers and sellers. And I think that's a fair market. We saw that last year, kind of going from the strong buyer side to kind of being more balanced, which I think exactly as you mentioned, I think that'll continue at least through the winter into the spring. Then I do think, we might see it ramp up a bit, but I think we're going to continue through the rest of the year, at least within Ottawa. So keep in mind, we're talking about Ottawa. We're not talking about Toronto. That's still going to continue to get decimated, but in Ottawa, at least that's going to continue along and kind of keep humming with as we continue going on.
Yeah, and one of the things that I wanted to look at here was the December numbers. So this is always kind of a hot spot whenever we post these every month. So we'll definitely keep doing so. But here are the numbers for December of 2025. So this is from the Ottawa Real Estate Board market update. So new listings in December 644, which I thought was actually extremely low. But when looking at the last 10 years, it's actually pretty much right on average for December as far as new listings. Benchmark price for single family, 697,700. Days on market, 38. So I think that was actually exactly what we had guessed. I think it was 35 or 38 for December. There's just kind of that a bit more lag in the market, and we're seeing it. Like, people that are selling are a little more hesitant, it seems now, knowing that it's going to take there's going to be a longer sales cycle. Actually dealing with two clients right now who are downsizing, and they're kind of in this impossible position. And actually, I'm gonna stop sharing this for a second to explain the story because I think it's relevant. I've had two realtors recently ask me, like, what options do clients have in this scenario? Essentially, clients own their home outright. They've been there for 20 years, 25 years. They want to now downsize, so they own their home free and clear. It's worth about 750,000. They want to buy a place that is kind of a bungalow, maybe with an additional unit in the basement, and they're kind of shopping in the 650 range. So downsizing, free and clear, basic can buy it cash. But they're in this position where, as sellers, they know it's going to be a longer sales cycle. So they don't want to buy something and then be in a panic to sell their place quickly. But they also don't want to list their place, have it sold, and have nowhere to move to. So they're kind of in this weird limbo. So, my suggestion, at least to them, was they have essentially three options. One, they can get, a flex line on their existing property to buy the new property cash until their place sells. They can get a firm sale on their property, find something, and then get some form of small private bridge loan to bridge that gap, which is going to be very expensive. Or they just line up the date so that their sale is the day before their purchase, and they're inconvenienced for 24 hours, but saves them thousands of dollars. So there's just no like clean cut option for people in this scenario, and there should be. I mean, people always say, well, how can we've earned all this, yes, you have all this equity, but also lenders, if someone's lending you money, they need to have some collateral, they need to have some security. So it kind of puts you in this tough position. And realtors are asking, like, what can we advise clients in these situations? And honestly, there's no clean cut scenario. But the reason why I'm saying this is because of that 38 days on market. That's really what's bringing up this kind of challenging situation, is that they know their place is going to be listed for upwards of a month and a half, and that puts them in a challenging situation.
Yeah, it's kind of a chicken and the egg situation.
Yeah.
And it's it's unfortunate because, even on the other side, when they find something, the banks are in the business of making profits, and they're not apt to providing, like, they don't want to provide open mortgages, or they don't want to do short-term lending on the A side or things like that. And that's kind of where the private kicks in. And then also debt servicing kind of comes into play on the A side, which becomes challenging if somebody's on pension or they're just relying on OAS and CPP, qualifying for a mortgage, even if they have the savings for a 20% down payment out of savings, and like being able to put on a new one, they don't debt service for that, loan of 500,000 if they're just on a small government, CPP, OAS, or whatever it may be.
Exactly.
And so they can't get to the A side because of that. And the banks understand that, you might be trying to sell this, but there's no guarantee you sell it. Like, intent isn't always like what becomes reality. And so maybe like, they can't just believe that somebody's going to like sell that property and just do like, even though the ratios are completely off because they have equity in another property, they like they could do that loan and then the client just take that mortgage property off the market and now rent it out. And now how are they going to afford that mortgage that they have on their new? So it really does put them in a bit of a predicament in that regard, even if they have that 20% down, just again, from that debt servicing and what the regulations allow for those debt to income ratios.
Yeah, and typically we get asked about bridge financing all the time, but typically, a true bridge, or at least I shouldn't say a true bridge, but kind of the standard bridge that you would get would be, your place is selling February 1st, but you're moving into your new property January 20th. We know your property is actually firm, no conditions, everything's been waived on the sale on the 30th. So the new lender who's offering you the mortgage on the January 20th purchase advances you a portion of your proceeds from the sale on the 30th so that you can buy this new property. And then when your place sells on the 30th, they take that money back. Now, in this scenario that we're talking about, they're not getting a mortgage on the new property, right? So there's no lender in there to kind of offer them that advance, meaning that when a private lender comes in to do that, because like you said, a kind of Schedule A or standard lenders are not going to do a 10-day bridge loan with no additional mortgage financing. So you're looking at upwards of 2 or 3% of the loan. And in this case, because they need basically the full purchase price, not just the down payment, if you're looking at a $650,000 bridge loan for 10 days, I mean, that might end up costing them literally like $25,000,
Yeah. Once you factor in legals and everything
Exactly.
else.
Yeah. Yeah. And that's just in fees and so on,
Yeah, like on the private side, for listeners, how they kind of guarantee that they're going to have that money back or that exit, even though the client can't regularly debt service, is that they'll register the mortgage on both properties. They'll register it on the property they're buying and the one they're selling, so that as soon as that sale closes, they know that they're getting their money back in that regard. They'll also, in some cases, defer payments until, they'll work with you as far as that structure with the mortgage broker and the client, maybe defer payments until that sale as well, or increase that loan amount that they're lending so that they have the proceeds to make those mortgage payments for those few months that it sits. It does become a bit of a challenge for those downsizing, and it becomes a kind of kick in the gut on those conversations because, like you said, they've done such a good job of paying down their mortgage. They're in their retirement, every dollar counts, and then they're like, not able to really get something that is favorable to them in an easy.
Well, even just explaining
manner.
it to them, they're kind of thinking like there's got to be a better option, like there's got to be something else. And it's like, well, unfortunately there isn't, like you can sell and then buy something, but that's obviously not overly convenient either. You're living in you're in your late 60s, early 70s, living in a moving truck for a night, or, staying with family and all your stuff loaded in the driveway. Like there's no clean, convenient situation here, yeah. Anyways, getting back to the stats
Back
here.
to the market. Yeah, back to the stats.
Active listings in December, 2,544. Benchmark for apartments, 86,800. And properties sold, 587. So that's a December wrap up. I'm interested now to know like where we land in 2026. And we ended the year last year with our summary of our 2025 predictions. So David, our best segment of the year, 2026 predictions. So I'm going to keep it simple this year. Same as last year. Price increase by percentage, total number of transactions, and the Bank of Canada rate change up or down percentage wise, because we're mortgage brokers. Let's keep it somewhat topical here. Last year, just to remind everyone, we were bang on, okay? 100%, 180 if we're playing darts. 3 triple 20.
Even on the days, so even on the sales number, because I know there was a YouTube question about that was challenging our estimate factoring in December sales, and I believe the calculation was off by, what did you say?
33.
33 so
transactions.
When we talked about it mid-December and we were giving our sales figures to match up with our predictions, we did an estimation of what the sales were going to be in December based on historical norms through 2025 and past. The calculation was we were off by 33 on the entire year.
Pretty good.
Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big, protect what matters most. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction at Gertin-Poirier Avocat Lawyers. We love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you for an effortless client experience that opens doors. Call us at 613-744-4488 or visit our website at gertinpoirierlaw.ca. Let's get to the heart of your deal. Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca. This episode is brought to you by Easy Neon Signs. Visit easyneonsigns.ca and use the promo code TOREP, TOREP, to get 20% off each and every order. easyneonsigns.ca, Canada's finest custom neon sign maker.
So let's
Just
see how we do this year.
Nostradamus over here.
So let's get the crystal ball out and let's do our prediction. So let's start with price increase, Dave. What are you seeing in 2026?
I think it's going to be a price increase of 4.5% to 5.5% as an aggregate across all property types.
Okay, I'm going to go 3 to 4%. I had 3% in there, but I'm going to give it a little bit of a buffer. I'm giving myself some grace, and we've earned it. Well, last year's predictions, we've earned the grace. Okay, so I'm going to say 3 to 4%. I think we're going to see a similar year to last year. I do think rates will come down a bit leading into the spring, which I think will stimulate the market. But I think leading into summer and fall, things will kind of stagnate again. So I'm going to say 3 to 4% increase in prices. Sales, next one is number of transactions. I'm going to increase it by 1,000. Last year I went 13.5. I'm going to go 14.5 this year, 14,500.
So I'm actually going higher than you. I'm kind of in that 12, 13% increase in sales number of transactions. So I'm saying 15,250.
Wow. Okay. I like it. And last but not least, Bank of Canada. So last year, a lot of movement. This year, I think we're going to see no change by end of year. Now, I'm not saying it's not going to go up or down throughout the year, but I think December 31st, 2026, Bank of Canada overnight rate will be the same. That's my prediction.
I'm saying it's going down by 1/4 point by end of 2026.
Going down for real?
We going down.
Yeah, no one got it. So there you go. So Dave said 4.5% to 5% increase, 4.5% to 5.5% increase in price, 15,250 number of transactions. Bank of Canada increase of 1/4 or down? Sorry, decrease.
Down.
Decrease,
Decrease of
1/4%. I'm saying 3 to 4% increase in values. Prediction of 14,500 transactions, and the rate's going to stay the same. Lock it in, David. I'm locking it in. We'll see how it goes. End of the year. Can't change it now. No going back. Let's get into some articles here, Dave, before we get going. Canadian employment rises 8,200 as jobless rate jumps to 6.8%. This was a Canadian Mortgage Trends article. Canada added 8,200 net new jobs in December, continuing a modest trend of employment growth. However, despite job creation, the national unemployment rate rose to 6.8%, up from 6.5% as more Canadians entered or re-entered the labor force looking for work. This increase reflects a growing pool of job seekers rather than a collapse in hiring, pointing to lingering slack in the labor market. The data shows job gains were largely concentrated in full-time employment, particularly in sectors like healthcare, social assistance, and construction. At the same time, part-time employment declined and overall labor market momentum remains fragile. The rising participation rate suggests Canadians are more willing or forced to seek work, but hiring is not yet strong enough to absorb that supply. So 8,200 new jobs, unemployment climbed to 6.8%, and most of the increase was in healthcare, social assistance, and construction. Anything surprising there for you, Dave?
Nothing really that's surprising, so to speak. The only one being gains in construction.
Yeah. I think that should be the case. Now, whether or not that should have been the case last year, probably the last 2 years.
Mm-hmm.
But it is good to see. But what's most confusing to me is that the unemployment is rising and jobs are still being added. So I think, there's going to be some point where that balances out. I think as the economy grows, hopefully this year, we will see more jobs created. I know the last year, the biggest kind of subsect that was impacted was that kind of new employment, kind of 15 to 24 age demographic, which typically are a lot of part-time jobs anyways, unless you're kind of coming out of university, new into career and so on. So I think as far as the economy goes, there's obviously more value in full-time jobs being created for the 24 plus demographic. Those are the people that are contributing more to society in the sense of the economy as far as taxes and everything, really, spending, etc. But I think in the short term, especially seasonally, well, in December at least, there's a lot of people that are working part-time jobs just to fill the gaps for retail, restaurants, a lot of seasonal jobs. Like, you look even in Ottawa down at the Christmas market, for example. Like, there's a lot of jobs that are created in the short term, but long term, I think as the economy grows, and as we see more new builds and things like that, like these full-time permanent jobs will be created. It's just a matter of when and how long it takes for us to get to that point.
Yeah, I mean, when is the big word there? As we continue to see geopolitically, nothing's been done with the U.S. On that front from a tariff negotiation. So there are still a lot of sectors still being hammered right now in the steel and auto lumber sectors that we're going to continue to get hit throughout the year. So it'll be interesting to see how those companies that are employing those thousands of workers get impacted and continue to get impacted, how long it takes to actually get an agreement with the US in that regard. But could that be offset with potentially an increase in the oil sector and high tech sector as far as, employment? So I think there are to this point, and I think where that increase in the unemployment rate is showing is that there are kind of cracks in the background as far as the labor market, that even though we're adding jobs, that people are coming back to the fray as far as needing to find employment to pay their bills, whether that be young, old, whatever it may be, and there's not the market to absorb those jobs that are people coming back rather. So I think over time, over the year, I think that's something that we really need to watch and really kind of, to that, how negotiations with the US go, especially after, everything going on with Venezuela. They're, seemingly in the horizon, they're could decrease their need for Canadian oil. How does that impact our sector if we aren't building pipelines or moving oil to our closest neighbor? How does that impact our economy as a whole? And that CUSMA negotiation, which would really harm the Canadian employment and Canadian economy pretty drastically.
Yeah, I agree completely. The other thing that I thought was interesting, just kind of holistically speaking about the economy and jobs and so on, was that the asking rent in Canada has fallen to the lowest it's been in roughly 2.5 years. So in December, the average rent declined by 2.3% from the prior year to about 2,060, which is the lowest, as I said, lowest it's been in 2.5 years. Rents are remaining elevated compared to the pre-pandemic levels, but the consistent decline is definitely a sign that there's easing pressure on renters, which I think is good overall. Like, I think that's kind of what we are hoping for. So I think, the pullback is likely being driven by a combination of different things. Like, rental construction last year, basically every new build we talked about was a rental building, or like, a purpose-built rental construction. Rising vacancy rates, slower population growth obviously has a massive impact. I know there's a lot of people that left Canada last year, but the actual population growth itself has slowed, so that helps. And then affordability limits. So provincial data shows rent declines across major markets like Ontario, BC, Alberta, and Quebec. It says while this trend benefits renters, it also reflects broader economic cooling and may influence future investor and buyer behavior. So that's the other side of it. Like, when you're looking at this from an investor, I was actually looking at a property yesterday and just kind of running the numbers on it. It definitely becomes like, as rates decrease, rent itself is not going to drop the same way as, like, if a rate drops, let's say a quarter point, the rent is not going to drop comparatively by that same amount. So like, as a landlord, if rates are lower and rent stays around the same, it's going to be more profitable. Obviously, it's going to be more attractive as an investor. And I know the last couple of years, the investor sector, and I know you have a lot of investor clients, Dave, kind of, I wouldn't say stepped away from the market, but kind of put everything on pause.
It dried up.
It dried up. Yeah. And I think, these sorts of shifts, like whether I think rates, which I expect to come down in the coming months, and rent kind of stagnating but slightly dropping, I think it just creates more interest back into the investor pool, which I think is needed right now. But time will tell. We'll see what happens over the coming months.
Yeah, I think a lot of the rental, I mean, all these figures that we talk about on a national level are most impacted by Toronto, Vancouver, and Montreal. Montreal still has, like, as a whole, has a strong rental market, but Toronto, with their influx of supply, not being able to sell a unit in Toronto that a lot of people are having to hold on to and really get whatever rent they can. Same as Vancouver. Ottawa is again much different. Our average rent right now is $21.53, so we're above the national average of $20.60, and we basically didn't have really any change. We ticked 0.5% lower, so we really, it was really a no change within Ottawa as a whole. Again, that kind of goes to what we've been seeing as far as our stability within the Ottawa market. So again, like when we talk about national numbers, that is taking into account some of the other markets that are not doing well. Again, Toronto just being absolutely decimated in their market as a whole. So that's something to keep in mind when you're looking at rentals, when you're looking at rents, what you could get if you're an investor. Really hone in on that specific market. Don't look at the whole of Canada. Look at that market that you're looking at, and just that one, to look at averages. If you're looking at vacancy rates, look at the, CMHC has vacancy rates based on location. So again, look at those for your average vacancy rates and your average rents. There's a lot of tools out there that you can use that are free to look into that, but don't look at really just like a national average, if you will.
Well said, David. Well said. Well, David, first round of mood boosts. What do you think? Should we slide into them? Anything else you want to cover?
Hopefully we're starting off the year strong on mood boosts. Don't
they're good.
All right.
They're good. I think we might go 3 for 3 here.
Wow.
Before we get into the mood boosts, I'm going to switch this up. Thank you to our sponsors, because everybody leaves. People are probably already left, to be honest. But Gertin Poirier, Avocat Lawyers, Big Insurance in Westboro, Centum, and Easy Neon Signs. EasyNeonSigns.ca. Use the promo code TOREP. Get 20% off each and every order. Here we go. Mood boosts. Number 1. The inventor of the throat lozenge has died. There will be no coffin at his funeral.
Okay.
Number 2. You should never tell someone you love them on January 1st. It's only the first date.
Oh, wow. Okay.
And last but not least, the difference between a numerator and a denominator is a short line. Only a fraction of people will understand this. God, only a fraction of people will understand that. I can't read, apparently.
Wow.
Thank you.
Well, everyone. We went 2 for 3. Because you butchered it. It could have been 3 for 3 if you hadn't butchered that last one.
Booker Stevenson. Thank you, everyone, for tuning in. We're back. It's 2026. We'll be here all year, every Wednesday, 10 a.m. We'll see you next week. Happy New Year.
Deuces.